All right, this is the second video now in answering question 25. Just to remind you, I'm looking at the New Era Accounting Study Guide. Question 25 that I'm helping you with the answers is on the web, so you can download that yourself. The memo is there as well, but this is just to assist you and help you so that you realize where you get your marks from. Right, so now we're looking at the second question, and it says, should the directors be satisfied with the operating, there's the important thing, operating activities as reflected in the income statement? Now, although they've said income statement to you here, it's actually not necessary. You need to know that operations, and you come across this word when you do cash flow as well, the operating of the business. That is the normal day-to-day business. It's buying your goods, selling your goods, paying your expenses, paying your tax, and so on. So we are looking at anything to do with profits and how well we are controlling our expenses, our incomes, and are we making a good profit? Again, looking at this, 10 marks. So we are again looking at least 5 points. You remember, you need to quote the financial indicator. You need to say this trend, what has happened to it, has it improved or has it decreased? And remember, as I said to you in the first one, you need to quote figures all the time. So again, the first thing we need to do is identify the financial indicators or ratios that they're referring to. So we're looking at anything that affects the profit. And you'll see here you've got your change in total sales, the gross profit on cost of sales, again gross profit on sales, net profit after tax on sales, operating expenses, operating profit on sales, and right at the bottom they give you your sales. Now all of those have got things to do with the income statement. So your comments for question 2 is going to center around these. So let's start by looking at our sales. We've been told over here that last year there was a 10% increase in sales, but this year there's a 17% decrease, and that is significant. Your sales have gone down. And if you look at the figures over here, you can see that last year your sales were 3.8 million, and this year they're 3,154,000. That's exactly what they're telling you there. Now, why is that? Why have your sales gone down? Your gross profit on cost of sales, this is your markup percentage, remember? And last year we marked up our goods by 67%. This year we're marking up, we're adding on more profit, and we're marking up our goods by 75%. Effectively, that means that we are making a larger gross profit. Now, that is exactly what this is telling me. Because my markup has gone up, I am making in percentage form a higher gross profit. The gross profit is higher on each shoe sold this year than it was last year. And while the 75% looks good, because remember they told us at the beginning that we actually wanted a 75%, the result of that is that our sales have actually decreased, whether we look at percentages or whether we look at the total. Now, it could well be that your customers are actually not prepared to buy your stock anymore because you're selling it too high. You need to consider the type of item, and remember we are shoes, and although some shoes can be worn throughout the year, some shoes are very exclusive and people will pay high prices. Shoes also can be very seasonal and very fashionable. And this is seeming to indicate that we are pricing ourselves out the market. So after having a look at the sales and looking at the changes, referring to the figures, referring to the markup, you've already covered a large percentage of what you actually need in this question. But the business is interested in its final net profit. And although we've got a net profit after tax, and we've also got an operating profit on sales, The difference between these two, will just be your interest expense and your interest income. So at this stage, let's just look at this net profit. Your net profit has gone down. So not only are you going to be quoting the net profit after tax on sales, you are going to say it has decreased from 14 to 11%. And that is not good, because ultimately at the end of the day, we are looking at maximizing our profit. Of course, because our sales have decreased up at the top here, is going to have a bearing on your net profit. But also your expenses. Look at this. Expenses have increased, and remember you are stating this in your answer, have increased from 30% to 37%. Now, while we live in times where of escalating costs, rents go up, wages and salaries, petrol prices, electricity, and so on, it is also important for a business to control as much as possible. They probably do expect to get some increase. Now, I can't say whether this 7% increase is actually justified or not. But what the owners of this business need to look at is, in view of the fact that they actually are selling less, are these expenses justified? Or is there some wastage or some abuse or some better controls that can actually be brought in? So in answer to our question, should the directors be satisfied? Now you need to say yes or no. I would say no, I don't think they should be happy, because the net profit has decreased from 14 to 11%. Why is that? Because the total sales have decreased by 17% this year, so we're getting far less in total money terms. We need to look at our markup, because maybe this markup is too high. We need to actually reduce it. And then also, I need to look at these expenses and see if I can control them and try and reduce them.